Well, over the last couple of weeks, we did a basic introduction into the sessions, and so we did a basic introduction of the treasury and the investment function, as well as corporate finance. Then we moved on to a little bit of equity, right? So we spoke a bit about equity, some of the instruments that are used in equity markets, and we will move on to debt markets later on, right? But before we get there, there are other types of investments that you can make other than debt and equity, right? So you can invest perhaps in what we know locally as unit trusts, right? Unit trust, where you invest in fund management companies, and they in turn invest in various instruments, right? So you might do it for various reasons. One is you might not have the expertise yourselves, right? So you might be perhaps a professional, maybe a good engineer or a doctor. So you might not have the time to spare to manage your own funds. If that is the case, you might assign it to an expert who has the time, right? It's his job to manage the funds, as well as someone who is capable of who has the know-how, the knowledge, and all that it takes to manage funds well, right? Now, if you are managing funds, there are so many attributes that you need to have. One is, of course, knowledge. You need to know about markets. You need to know the interdependence of markets. You need to know that one market can have an impact on another market, that markets don't operate in their own silos, things like that. Then the other thing is you need to have experience, right? You might have all the knowledge, the theoretical knowledge, but if you have not worked in markets, then it's a different ball game, right? If you are working for the first time, then you might find it very, very different to what you learned, because markets have their own dynamics, some of which the soft skills are very difficult to teach. Then there are other attributes like things like you should not panic. Right? Because markets can all of a sudden have certain fluctuations, variations, which you might not be able to comprehend. You might not understand what is going on. It might be totally out of the blue, something which cannot be explained. Now, these are called irrational thinking of investors. People cannot always predict markets now, otherwise everyone will come and do the same thing, isn't it? Because now, for example, if I feel that a certain share will go up, then there should be someone who feels that the same share should fall. Otherwise, if I want to buy, the other person will not sell. If there are, right? So for you to buy, someone should sell, no? If you are buying, you have a certain point of view, and if the other person is selling, he would have a different point of view. Likewise, if you are selling, you will have one point of view. You might feel that the share will fall, and the other person is buying because he feels the share is going to go up. And so there should be directly opposite schools of thought. Otherwise, markets will not become liquid. If everyone feels the market is going to go up, then there are no sellers. No one, the share is going to be illiquid, right? And if everyone feels the market is going to fall, only sellers, no buyers. Still the same effect. Yeah. So I know. For you to feel the market is going up and the other person to feel the market is going down, if both of you have the same sort of information, unless you have inside information, which is illegal, it is well, it depends on lots of other things like the ability to analyze the market, the information that is available for the public, and things like that. So if you have the same knowledge, the same intelligence and all that, for you to have different schools of thought, there should be some other thing behind it, right? So this also should exist in markets. Certain people should think the market is going up, others should feel the market is going to go down. That generates liquidity. It also creates volatility, right? Because all of a sudden, if there are only sellers in the market will crash. That's when you see markets just going down, a free fall in markets, or a sudden spike in markets. If everyone feels the market is going to go up, you might see a spike, okay? Because there are no sellers, all buyers, the market will spike. Now, these can be irrational sometimes. can be herd behavior. Very difficult to explain. It's beyond a textbook, what a textbook can teach you. Sometimes beyond comprehension. So this irrational nature makes markets volatile, and if you're a good fund manager, you need to be very focused, and you should not panic. You should be ice cool if markets go against you. Right? Because if you panic and you hit the panic button, that is going to be a disaster. You might make a wrong decision, so that markets settle down, and then you take a call. Right. So some fund managers get panic when they start making losses. So losses are part and parcel of the game. Not everyone can make profits all the time. So if you have 10 trades and you make profits on 7 of them, and the 3 losses that you make are more than compensated by the gains that you make, then you're a good fund manager, fantastic fund manager. And so 7 out of 10 is what you need to target. Then you're an excellent fund manager. But if you get more than 5, they are good. You're good. You've done well. So that comes with expertise. Yeah. Soft skills, which are difficult to train. Now, if you are busy, like we mentioned earlier, an engineer, a doctor, a lawyer who's busy, has no knowledge of markets, doesn't have the time to spare, you can park your money with another person, an expert who is more than you. He might have the capability to manage your funds on his behalf, right? So that's why, and also you might not have access to certain markets now due to various restrictions, right? So you might maybe your company does not invest in equity and has no policy to invest in equity. So you choose a fund manager who has unit trust which invest in equity, or you choose a proxy investment, something like that, right? So for these kind of reasons, people invest in unit trust, and also the risk is also distributed amongst all investors. Right now, if you are investing on your own, right, and you go and put your money in FD in a certain bank, let's say bank A, right, you're taking 100% risk. But if the unit trust, if you're investing in a unit trust, then all the investors will be investing money in that unit trust, and the unit trust will be splitting it amongst various institutions, maybe banks, finance companies, and all that. Right? So everyone is taking, the risk is actually distributed. You're taking overall less risk. And for these reasons, people tend to invest in unit trusts, different types of funds. So today, our focus is going to be what type of funds you can invest in. Okay. So the first one is called a mutual fund. Now, this is somewhat similar to unit trust. It is a trust that pools the savings of a number of investors who share a common financial goal. Right now, might be a short-term investment. Your financial goal might be short-term. Maybe you do not want to block your funds for long-term. So investment horizon might be 3 months, 6 months, perhaps 1 year. Or you might be long-term investor, right? Not a short-term investor, but you might be willing to invest for a longer term. Give me a second. Same time. Same time. Right. By the way, I have good news for you. Right. There's a long weekend coming this end of this week. So we will be meeting 2 out of the 3 days, right? Friday as well as on Sunday. You will be stuck with me on Friday as well as on Sunday, right? Same time, 3:30, 5:30. Okay. Yeah. So I just ate into your long weekend. But then, having said that, there is nothing you could do. No, you can't. It's always safe to stay at home. Better not leave the house, right, until things settle down and the country fully opens up. So, well, hopefully, we will be able to meet sometime, somewhere down the line, physically in class, so that we can have a very interactive session. Otherwise, I don't know whether this what I'm preaching is going into your head, or whether it's just going miles above you. Right? Whether you understand or not, no idea. I hope. Well, I've been jabbering a lot, but I couldn't check whether you all can hear me. Can you guys hear me?
Yes, sir.
Okay, thank you, thank you. Thanks for the feedback. Right, so we meet again on Friday at the same time. Don't forget. I'll write it down. Friday would be the 23rd. To 5:30. Yeah. Okay, so provinces are closed. You're not supposed to cross provinces. Might open up on the 19th. I'm not sure. But for now, it's maybe safe to stay at home. And hopefully, you might not have plans for this weekend. Okay, but I just gave you some good news that you're stuck with me. Right. Having said that, let's get back. Yeah. Okay. So mutual funds. We want to mutual funds. Common financial goals, right? Some investors might be short-term investors. Short-term investors, others might be long-term investments, but and perhaps your objective might be to invest in equity. You feel the equity market is doing well, interest rates are low, so you prefer to avoid fixed income and you focus on equity markets, right? But you don't have the time to do it. Yeah? So your objective is to maybe invest in conglomerates, right? And make a gain. You feel the country is going to open up and more and more consumer demand is going to increase. Pent-up demand is going to flood the industry, and people will tend to go use hotels perhaps more and more. And so like that, you might have various objectives and you prefer to have an exposure into maybe the hotel sector or conglomerates or whatever, right? So this might be a financial goal. You want to gain out of the equity market boom, which you are expecting. That might be a financial objective or your goal. So what a unit trust or a mutual fund would do is they will set up a fund that suits that kind of investors, right? They might have a focus in particular segments, maybe the banking sector. So they might have a banking sector fund or the hotel sector fund, maybe the tourism sector fund. Or they might have a diversified conglomerate sector fund. So likewise, they might have various funds. Now, if you are an investor, you can pick and choose amongst these funds. First of all, you should have an idea about where you're going to invest and for how long. Are you going to invest for the long term or the short term? Right now, what these funds will typically do is they will do an investor policy statement or an IPS. Yeah. They will meet each and every customer ideally and have a one-on-one discussion to understand the objectives of investors as well as the constraints. What are the constraints? Objectives and the constraints, right? Can you all see the board? Perhaps I wrote a little too high. Objectives might be in terms of return or risk, right? Then your constraints might be pertaining to liquidity needs, time, taxes, legal and regulatory, or unique circumstances. right? Yeah, sorry. Return. The investor might say the target return is 10%. Then in terms of risk, you will look at the customer's ability as well as his willingness to take risk. Right. Now, the ability of a customer to take risk might depend on his net worth. Right now, if this guy is a high net worth individual and he has a significant knowledge of markets, he's relatively young, then his ability to take risk might be pretty high. But well, if he is old, maybe he's in his 70s, right? And he perhaps doesn't have a lot of money, no real cushion, lots of loans to repay, commitments towards his children is there. If that is the case, his ability might be low. So you need to have an understanding of the customer's ability to take risk. Then what is his willingness? Right? You might have a rich guy, high net worth individual, but he's not willing to take risk. No risk at all. Just invest in government treasury bills or bonds or NSB FDs. Nothing at all. No other risk. Right? So ability might be high, but willingness is low. Right? And you look at these aspects and decide on the risk tolerance, which can be high, medium, or low. Right. So you need to have an understanding about the customer's risk tolerance, whether it's high, medium, or low. Then the constraints, liquidity. Investors might have various liquidity needs. Right? And maybe some of your customers might have an intention to put up a house within about 1 year. So they might have a huge capital expenditure coming up within 1 year. And so that should go through your mind. You should have this understanding. You should talk to your customers and make sure that they have enough liquidity to cover these needs. Otherwise, they might have to sell their investment at a significant loss. Erosion of wealth might happen. If you don't, if you ignore that. Right. So liquidity needs to be looked at. Maybe a child's education or a wedding is coming up. Yeah. So that might cause liquidity constraints. Then the time period. What is his investment horizon? Is he a long-term investor or short-term investor? Right? You should be mindful of that. Taxes. Now you make an investment, and if the customer ends up paying lots of taxes, which he might not have paid if he had not invested, then the effect is worthless. Right? So you should be mindful of the tax liability of the customer. Legal and regulatory framework. Right? You should know the kind of jurisdictions that apply to customers' investments. Now, if he's a US citizen, then maybe FATCA might apply. If he's based in maybe Dubai, certain other regulations might apply. But if he's in Sri Lanka, then a different set of regulations will apply. Right? So you should be mindful of that as well. Then unique circumstances, maybe your customer does not want to have any exposures to tobacco or alcohol manufacturers. maybe he's a Sharia compliant. He wants to be Sharia compliant. So those are unique circumstances. You should be focusing on those as well, right? And you should look at all these aspects which can come into a document called the investment policy statement, or the IPS. Right? Okay. Any questions up to now? Any questions? Yeah, so it's very important to look at a customer's investment policy statement. If you violate it, or if you don't have it, then you might be in trouble. Right? Right. So mutual fund is a trust, meaning there will be a trustee. Right. They will make sure that the fund operates within its defined framework. They cannot exceed it. They cannot exceed the authority. Every investment, every transaction will be monitored by the trustee. Right. If there is any breach, that will be a breach of trust. The fund or the fund manager can be taken to task, can be sued if that happens. Professional fund managers then invest these funds in a way that helps investors achieve their goals. Okay, so this cannot be done by amateurs. It will have to be done by professionals. Right? Fund managers, people who are experts in managing funds. A mutual fund is managed by a company or an asset management company. Now, if the asset management company violates their mandate, they can be replaced by the trustee. The trustee will replace the manager with another manager, right? It's not a big issue. So the fund asset management company needs to be very mindful of these conditions. They should not violate their mandate. Very, very important. Yeah. The portfolio of mutual fund is managed by a portfolio manager, whose responsibility is to be invested in and satisfy the desire of investors, right? So within this asset management company, you might have portfolio managers. Now the portfolio manager will be managing all the assets within that portfolio. So he might be a fixed income fund manager who is specialized in fixed income, or there might be an equity fund manager who is specialized in investing in equities, or maybe a derivatives trader. Right? They will be managing their own portfolios. So within each portfolio, there'll be, well, one is there'll be firewalls, right? So one portfolio manager will not know what the other portfolio manager is doing, or what his strategies are, or even who his customers are. Right? So it's very typically, they cannot know who has invested within one portfolio unless the customer gives authority to switch between portfolios, right? So if the customer has not given authority to switch from his equity portfolio to the fixed income portfolio, there should be absolute Chinese walls between these two portfolios. One is not supposed to know who has invested in the other portfolio and how much, right? If any information leaks, there is a breach of trust, and the fund can get into serious trouble. So portfolio managers will be managing their respective portfolios, right? They can have various assets, but they will be focusing only on that particular segment and those particular customers. So they will have to have an idea about the type of investments they are allowed to make, and the kind of customers they have. What are the expectations? So very, very important for portfolio managers to have these things in mind. Right? So it's very important that he satisfies the desires of investors. Very important. Every day, the fund manager or the portfolio manager counts up the value of all funds holdings, figures out how many shares have been purchased by the shareholder, and then calculates the net asset value of the mutual fund, the price of a single share of the fund on that particular day. Okay, so what this portfolio manager does is he will get investments coming in from various investors, right? So people will be investing in different amounts, and this portfolio manager will be in turn investing in various assets, right? Maybe in bonds, in equities. So end of the day, what he does is he pools or aggregates the total amount of investments he has made and divides by the number of units. Okay, so he will arrive at the net asset value or the unit value of the fund every day. It's being marked to market every day. Okay, so this is the typical flow of funds. Investors will pool their money with fund managers, and the fund manager will invest in assets or securities, and these securities will generate returns, which will be passed back to investors, right? So that returns will again get invested into the fund, and it becomes a cycle. Yeah. A fund's net asset value fluctuates along with the value of its underlying investments. The formula for net asset value is the market value of all securities held by the fund plus cash and equivalent holdings minus liabilities. So you take, in other words, all the assets minus all the liabilities and divide by the number of units or the shares that are created. Okay, so it's the market value of all securities held by fund plus cash and equivalent holdings minus liabilities, which is the net assets in effect, right? Effectively, the net assets of the fund divided by the number of shares. Okay, so let's try this example. You will understand better. It says, let's assume the close of trading yesterday that a particular mutual fund held 10.5 million worth of securities, 2 million worth of cash, and 500,000 liabilities. If the fund had 1 million shares outstanding, then yesterday's net asset value would be what? Simple calculation, you need to calculate net asset value, right? So it's net assets, meaning total assets minus liabilities, which gives you net assets. NAV, or the net asset value, will be total assets minus liabilities divided by the number of shares. It's a total assets, 10.5 million worth of securities. $2 million cash. So cash is also an asset. 500,000 liabilities. It had 1 million shares. Net asset value of this fund is $12. So each share is worth $12. Now remember, in open-ended mutual funds, which we will get into later, in a short while, the net asset value is, or the unit value is the net asset value per share. Now, if an investor invests in this today, he will be investing at a price of $12, right? Then this is done today. Now, tomorrow the values might change, right? His securities might increase from 10.5 to 11 million. Then cash might drop from maybe 2 million to 1.8 million. Yeah. So on the 19th of July, in Navy, this is 18th July. In Navy on 19th July, in that case, will be from 10.5, the security value goes to 11. It will be 11 plus 2 million cash reduces to 1.8 million, and liabilities remain, let's assume, at let's say increases to 0.6. Right. The 1 million shares outstanding. Then the net asset value will be 12.8 minus 0.6, 12.2 divided by 1 million. Okay, so it's $12.2. Yeah. So on 18th July, if your client had invested in a share, he'll be investing at $12. The next day, his investment will have increased to 12.2 million, $12.2. Each share is worth now $12.2. And so he has a $0.2 gain. Then maybe on the 20th of July, if you calculate the net asset value on 20th July, securities might have dropped maybe 10 million. Cash dropped to 1.5 million. Liabilities increased to 1 million. Number of shares remains at 1 million. So this is 11.5, 10.5, and unit price is now 10.5. Clear? So the unit price can keep changing depending on the market prices of these units. It can either go up or go down. Yeah. So if your customer has invested at 12, he waited for 2 days, his unit price is now 10.5, he'll make a loss. But the next day, if he had sold, he can sell at 12.2. He makes a 20% gain. Yeah. So that's how unit prices are calculated, and your customers' profits or losses are also computed. Clear? Understood? Any questions on this? No questions?
Excuse me, sir.
Yeah.
This might be a stupid question, though.
No stupid questions. Don't worry. Yeah.
What are the liabilities we are talking about in this case?
Liability.
Yeah.
Yeah.
Examples?
Funny?
Examples? Can you give me like examples?
Yeah. Well, certain funds can have different strategies. Like some might be leveraged. That means if the total investments that a fund got is 10 million, and they have bought, let's say, treasury bonds of 10 million, what they can perhaps do is they can pledge some of these bonds as securities and repo against it, right? So they can raise additional funds. Maybe they might, against this $10 million, they might raise an additional $1 million, right? Now this $1 million comes in as cash flow, but it still is a liability which has to be settled. Things like that. If there is leverage in the fund, you know what leverage is, do you?
Yes, sir. Thank you.
What is leverage? What do you mean by leverage? Leverage is good or bad? That was a good question, by the way.
Leverage is bad, right? Because we are using the debt to finance the assets.
Okay. Yeah, good point. Something like this. Right? The point you made is very valid. Let's say you have cash of 100, right? Say 100 could be 100 million, 100 billion, or whatever, 100,000, anyone. Let's say it's 100, and you are investing this in a simple FD or any asset you want. Let's assume it is a FD at a rate of 10%. So after 1 year, what will be the return? 100 invested at 10. Yeah, you get a return of 10. With capital, it becomes 110, correct? Yeah, so your return is 10. Now, if you are not happy with this, what you might do is you might want to borrow, right? And you go to a lender who is willing to lend to you. Maybe with or without security, you leverage 10 times and you borrow 1,000. You put it in the same FD, right, at 10% again. Now on the 1,000, how much do you earn?
100.
You earn 100, right? Let's assume that you have borrowed 1,000 at 8%. At 8%, right? So after 1 year, you have to pay interest of how much?
80.
80. Okay, so you have your original investment of 100. This is original investment, which is your own money. Then you take your loan. And your total return from the 100 you get 10. Using your borrowed amount you get 100 and you pay interest of 80. So you have 110 minus 80, total return of 30. Correct? So after 1 year when the FD matures you get 100 plus the capital of 1,000. You settle your loan 80 and you repay the capital, right? So this loan is gone after 1 year. Now you are left with a net profit of 30, isn't it? Yeah? Agreed? Understood? No?
Yes, sir. Thank you.
Yeah. Okay. So you are left with 30, right? So what is your return on investment now? What is your return on investment? Your return is 30. Your investment 100. So you make a 30% return. Correct? Is that clear or not? You understood or didn't understand? Hello?
Okay, sir.
Yeah. Okay, so you make a 30% return. But if not for the borrowing, your return will only be
10%.
10%. But now you're making a 30% return. Why? Because of this. You're borrowing. Yeah. That is called leverage. You borrow and invest, it's called leverage. Okay. Right, so that's good, excellent. But all of a sudden, what happens? What happens if your borrowing cost jumps to 12%? Not 10, it goes to 12. Now you pay interest of 120, right? And your return drops to negative 10, no? 10 plus 100 minus 120, you end up with minus 10. Okay, so your return is now a negative 10%. Yeah? That's good or bad, no? Yeah, your return is now negative. If not for the borrowing, you have ended up with 10% return. But now you are ending up with negative 10%. That means you're eating into your capital. You will lose capital also. Negative return is you lose capital. Okay. Yeah, Marisha, what you said is correct. Leverage will make you money, or you will make money from leverage for as long as your return is more than the borrowing cost, the cost of borrowing. So if your return is more than the cost of borrowing, then leverage is good. Otherwise, it can be a disaster. Yeah. So for leverage to work, your return should be more than the cost of borrowing. Is that clear? Any questions? Are we clear on that? Yeah. Okay. So no further questions. Let us move on. Right. So this is something that you need to remember. Okay, you need to remember how to calculate net asset value, and then you need to also know the types of mutual funds. Right? Types of mutual funds. There are two types of mutual funds: open-ended mutual funds and closed-ended mutual funds. By structure, there are two types of mutual funds. Right? So this is by structure, open-end and closed-end. So you need to remember the two types of funds as well as the features of each of the funds. Mutual fund can generate profits from two different sources, which are dividends and capital gains, right? It's like investing in equity. You can have dividends as well as capital gains. Open-end funds. Open-end mutual fund is a company which aggregates money from many investors and invests the money in stocks, bonds, short-term money market instruments, or other securities. Yeah. It invests money in stocks, bonds, short-term money market instruments, or other securities. Investors purchase mutual funds, fund shares directly from the fund itself. Very important point, right? You need to remember that, because when you're dealing with an open-end mutual fund, you're dealing directly with the fund. It doesn't trade on an exchange, right? So your dealings are directly with the fund. You negotiate only with the fund. Investors purchase mutual fund shares directly from the fund itself at a price that is determined by the fund's per share net asset value, what we just computed, plus any shareholder fees that the fund imposes at purchase. So there can be fees on top. They might say 1% fees, right? Mutual fund shares are redeemable. That means they have a maturity. If you want, you can sell it off. When the holder of the mutual fund shares wants to sell those shares, he or she sells them back to the fund. So remember, you negotiate and you deal only with the fund, nothing else but the fund only. Open-end fund shares cannot be bought or sold in secondary markets. Right? So there is no secondary market. You buy it, you keep it with you. Shares such as the New York Stock Exchange or the NASDAQ. There can be unlimited capitalization. That means any investor can come and invest whenever they want. Unlimited capitalization. No predetermined date of redemption. Right? There is no date of maturity. Sales and purchase of units should be at current net asset value. Okay, so any sale or purchase of unit will be at the net asset value, which we just calculated. So if the net asset value is 12, if you're investing today, your price or your investment value will be at 12. So daily there will be mark to market and the price will be calculated once again or recalibrated. No restrictions to enter or exit. Okay, so remember these points. Then the majority of mutual funds are open-end funds, right? So these are some important points. Open-end mutual funds, you deal directly with the mutual fund itself. They don't trade on an exchange. There is unlimited capitalization. These are redeemable, and the unit price is based on the net asset value. Right. Then closed-end mutual funds. It is an investment company that sells a fixed number of shares at one time initial public offer. So it's like a share. Units are sold in an IPO. Shares are not continuously offered for sale. Okay, so there is an initial launch on an exchange like an IPO, and after that there is no new issues. Right, so it's like a share, typically like a share issue, IPO. Now recently there were several IPOs, right? We had Winforce, Chris World, right, and Prime Residencies, Prime Land, sorry. Right, so these shares are initially sold at a IPO, and then the price keeps fluctuating, not based on net asset value. Net asset value has nothing to do with it. It's based on demand and supply after that. Okay, so remember, market forces are also different. It is an investment company that sells a fixed number of shares at a one-time initial public offer. Shares are not continuously offered for sale. After the public offering, the shares typically can be bought or sold only on a formal exchange, such as the New York Stock Exchange or the NASDAQ. Right. So these are exchange-traded funds. Unlike an open-end fund, a closed-end fund is exchange-traded. So you do not deal with the fund, you deal in the exchange. Once closed-end fund shares begin to trade, their prices are determined by supply and demand and not by net asset value. Net asset value has nothing to do with it. It's entirely based on demand and supply. Okay, now typically shares, once they are listed, usually don't trade based on the net asset value, right? Some shares do. For example, if you take banking shares these days, they are trading at half the net asset value or half the book value. Whereas certain other sectors are trading at 2 times the book value, okay? Or several number of times the book value. So usually net asset value or book value does not have real significance on the share price, but the share price rather depends on demand and supply. Book value also can have an impact, but it's rather based on demand and supply, right? So if there is excess demand for a share, then the price will go up, and if there is excess supply, the price will fall. So it's based largely on demand and supply. So likewise, a closed-end mutual funds also based on demand and supply and not on net asset value, right? So you rarely calculate net asset value. As an academic exercise, you can of course calculate net asset value, but remember, they trade based on demand and supply. The closed-end funds, the market price may be greater or less than the share net asset value, right? Because it has no direct impact on the net asset value, or net asset value does not have a direct impact on the price of a closed-end mutual fund. So there is a secondary market, unlike in an open-ended fund, where the fund does not trade on an exchange. So there is no ready-made secondary market. Closed-end fund is not required to buy its shares back from investors upon request. If you want to get rid of this share or the fund, all you have to do is go to the exchange and sell. It's like buying and selling shares. You want to enter, you buy it from the exchange, and you want to exit, you sell it in the exchange. Simple as that. Whereas if you're dealing with an open-end mutual fund, you deal directly with the mutual fund itself. Yeah. Any questions up to now? No questions? So remember, it's important that you remember the distinguishing features between open-end mutual funds and closed-end mutual funds, right? So if we can recap, open-end mutual funds have unlimited capitalization, right? Unlimited capitalization. They do not trade on an exchange. All dealings are with the mutual fund, and the unit price is based on net asset value, right? So let's write those down. Open-ended funds, you deal with the fund. Closed-end funds deal on an exchange. Right. Then capitalization. Open-end funds unlimited. Unlimited capitalization means anyone can come and invest at any time they want. Closed-end funds, limited capitalization. Because it's based on an IPO. Right? And unit price is based on NAV, whereas closed-end funds based on demand and supply. Open-end funds, they trade on the over-the-counter market, whereas closed-end funds trade on an exchange. Okay, so these are the key features. Any questions up to now? No questions? Okay. So let's move on. Then you get into hedge funds, right? So types of funds, we already discussed mutual funds. There's another type called hedge funds. Now, this is an interesting category because not everyone has access to hedge funds. Right? Hedge funds, highly complicated kind of fund. Okay, not everyone has access because you will be allowed to invest in a hedge fund only if you're high net worth, right? So if you have access to a hedge fund, then you are in the elite league. Not everyone has access to hedge funds. And you should also be financially sophisticated. You can't be an ordinary investor, wake up one day in the morning and decide you want to invest in a hedge fund. Not allowed. You have to be high net worth and financially sophisticated. Those are the two most important things. So if you're only high net worth, they will still not allow you to invest in a hedge fund. Both those conditions should be fulfilled, right? You should be high net worth. That means you should have a cushion to absorb any losses. And also you need to be financially sophisticated, right? You can't be a nut to invest in hedge funds because they take excessive risk, high risk, lots of risk. Very risky to invest in hedge funds. You can get burnt. But the returns also can be very, very attractive. Hedge funds, a private and unregistered an unregistered investment pool that employs sophisticated hedging and arbitrage techniques to trade in the corporate equity markets. Right? They remember this is very important. They employ sophisticated hedging and arbitrage techniques. Right? Sophisticated. That is why you need to be high net worth because their strategies are very risky. They can either make huge profits or huge losses. Hedging and arbitrage. Hedging is hedging tools, right? Forwards, futures, options, and swaps, which we are going to discuss in the future. They can use sophisticated hedging instruments as well as arbitrage techniques to trade in the corporate equity markets. Right? So what is arbitrage? What do you mean by arbitrage? Any idea what is meant by arbitrage? Yeah. What do you mean by arbitrage? Remember the rogue traders that we discussed about 2 weeks ago, Nick Leeson, Kwepa Depoli, Jerome Kervale, and Bruno Excel. Right? These guys were also supposed to use arbitrage trading techniques. So what is this arbitrage? It means they are supposed to make supposed to make risk-free profits. Risk-free profits. How does it happen? How can you make a risk-free profit? Yeah. What do you think? What do you all think? How can you make a risk-free profit? Any idea? It's something like this. Yes. Maurice, simultaneous buying and selling of securities and currencies. Okay. Yeah, you're getting that. In order to take advantage of price. Yes. Yeah. Quite right. You have the idea, understanding. Very good. Sanjeev Ramalingam, buying and selling some assets in different markets to avoid risk. Very good. Very good. So both of you who have responded, it goes to show that you have a fair knowledge of arbitrage. That's because you probably have either heard or read somewhere. That shows the importance of reading. Right? This subject, you can score 50% of your marks if you read. Very easy. So the balance is just exam techniques. Okay, so it's a very simple subject, as I keep saying. Now, arbitrage, let me explain what it means. It's something like this, or this pen. Right? Let me use this pen as an example. It has two components. It has a clip as well as the pen, right? So let's say you put the clip plus the pen together, you get a marker, right? Now let's say the clip is priced at 10 and the pen is priced at 100. So the marker should be priced at 10 plus 100, 110. But if you go to the market, you go to a bookstore, you all of a sudden find the marker to be priced at $100. Okay. Now let's just assume that there are enough buyers and sellers for clips, there are enough buyers and sellers for pens separately, and there are enough buyers and sellers for markers also. Yeah. This cannot be, no? Because if you buy a clip separately 10 rupees, pen separately 100 rupees, but you put them together, you get 100. I'll come back to this example, but look at this, right? You take two cities in the country, Galle and Colombo. The price of a mango in Galle, let's say, is 10 rupees. And the price of a mango in Colombo, let us say, is 100 rupees. Yeah. So if you are smart enough, what will you do? What will smart investors do? Yeah. Yeah, you're right. What you can do is you can buy mangoes from Galle. The price of mango in Galle is 10. The price of the same mango in Colombo is 100. So you keep buying mangoes from Galle and you keep selling them in Colombo. Right? You buy one mango from Galle, sell it in Colombo, you make 90 bucks. Same mango, two different markets priced in at two different levels. Right? So you can keep buying from Galle and you keep selling them in Colombo. Keep buying from Galle, sell in Colombo. So you buy from Galle, sell in Colombo. Every mango you make 90 bucks. Okay. But what happens if you buy from Colombo and sell it in Galle? If you buy from Colombo and sell it in Galle, then what happens if you buy from Colombo and sell it in Galle? Yeah, then that is called charity. Right? Buying from Colombo and selling in Galle is called charity. But buying from Galle, selling in Colombo is called arbitrage. Why? You're buying the same product the same commodity, right, the same product. You're buying in one market and selling it in another market and making use of the mispricing. It's called arbitrage. This is arbitrage. But arbitrage opportunities may not last for long. It may not last for long. Why? Now, if this continues, everyone will start buying mangoes in Gaul. And everyone will start buying mangoes in Gaul, and they will start selling mangoes in Colombo, isn't it? So the demand for mangoes in Gaul will go up. Everyone wants to buy mangoes in Gaul. So when the demand goes up, the price will also go up, right? So the price of a mango in Gaul will go up, and everyone wants to sell mangoes in Colombo, so the price in Colombo comes down. Eventually, they will converge. Okay, so arbitrage will cease to exist at that point. Then there can be logistic issues coming in. Transport cost, storage, pilferage, right? Might become obsolete or stale, rotten, things like that, wastage, damage. Then taxes, there can be taxes. For various reasons, arbitrage may not last for long, but for as long as they are there, you can make profits. Then there should be a critical mass. Right? Critical mass. It's not worth to buy one mango from Gaul and go and sell it in Colombo. Not worth. 90 rupees, you can't even buy a plain tea for that cost, right? Forget traveling. Okay. So critical mass may not be there. So for these reasons, arbitrage may not last for long. But for as long as there are opportunities and you can make profits, you must certainly do it. Okay. Coming back to this pen example. Do you see an arbitrage opportunity here? Do you see an arbitrage opportunity? If so, what is the opportunity? How will you make use of this arbitrage opportunity? Yeah. Excellent, excellent. Yes. Now, if you look at these two sides, right? The right side is cheaper and the left side is expensive. Right side is cheaper, left side is expensive. Okay. So what you need to always do is you need to buy the cheaper side. Remember the mango example? Gaul Colombo. Okay. You buy the cheaper side, you buy from Gaul, and you need to sell the expensive side. So you sell it in Colombo. Likewise, you need to buy the marker because it's the cheaper side. You buy the marker and sell the clip and the pen separately. So your cost is going to be 100. You sell clip separately, you get 10. You sell pen separately, you get 100. You make a 10 rupee gain. Okay. So what you need to do is you keep buying the marker and selling clips and pens. You arbitrage. Then what happens is when you keep buying the marker, the demand for the marker will go up And when you keep selling clips and pens, the demand for the clips, the supply of clips will go down. The supply. Sorry, I'll come again. When you keep buying markers, the demand for marker goes up. So the price of the marker goes up. And when you keep selling clips and pens, the supply of clips and pens keep going up. When the supply goes up, the prices of clips and pens will continue to drop. Yeah. Clear? Any questions on that? Understood? Is that clear? Okay. Right, so that's arbitrage. Yeah. Any questions? Okay, so no questions. So hedge fund is a private and unregistered investment pool that employs sophisticated hedging and arbitrage techniques to trade in the corporate equity market. Hedge funds have traditionally been limited to sophisticated, wealthy investors, right? So you need to be sophisticated as well as high net worth. Remember that. Hedge funds may not use leverage, make bets on global basis, or look at technical aspects of a security in an attempt to find a mispricing in the marketplace. Hedge funds differ significantly from mutual funds because they generally only accept financially sophisticated and high net worth investors. Some funds are limited to no more than 100 investors, right? So it's very difficult to get into a hedge fund. Hedge funds engage in leverage and other sophisticated investment techniques to a much greater extent than mutual funds. The fee structure of a hedge fund, the manager usually gets a base management fee. So remember, they can use leverage and sophisticated hedging or derivative instruments, right? Fee structure of a hedge fund, the manager usually gets a base management fee based on the value of assets in the fund, such as 1% of the fund's assets. So there's base fee. They might say 1% of AUM, assets under management. And so if there is 2 billion assets under management, 1% of that is about 20 million will be charged as a base fee. Yeah. Then managers also receive an incentive fee based on their performance that typically ranges between 15 to 30%. So if their performance is fantastic, brilliant, they did really well. Okay, now there might be a base case return. Now the base case return might be, say, a return you can fix at 15% or 20% for a year. Anything above this, it's called a watermark level. Anything above the watermark, let's say the manager initially gives a target of return of 20%, right? But end of the year he achieves 30%. Then additional 10% on top of the target 20%, the additional 10%, about 15 to 20% of it, a good chunk will go to the fund manager. Okay, that's how hedge funds are structured. Huge fees because they take exceptional risks. Exceptional talent is recruited to manage hedge funds and they charge for it. You have to pay a premium to be in this. types of hedgers can be direct hedgers, right? These are hedgers, not hedge funds. Remember, these are hedgers. Types of hedge funds, you have a separate lot. So types of hedgers can be direct hedge. Now, these are the ways of managing risk, right? Don't get confused with the word. Hedge funds and hedging are two different things. Hedging means managing your risk. You can manage it through direct hedges. This is accomplished by hedging one asset, such as common stock, with another asset that shares similar price movements and trade in a similar fashion. An example of this would be hedging a common stock position with call options. So we'll see what call options are later on. Then you can also use a cross hedge. This involves hedging an instrument with an unlike instrument, right? Buying, for example, buying long preferred stock and hedging this position with treasury futures. So you're using, maybe if your risk is the price of this pen going up, you might use the price of a bottle to hedge it, bottle of water to hedge it, right? So that's called a cross hedge. If you're using the price of identical products, it's called a direct hedge. So you can use either direct hedge or cross hedge. Okay? Then hedge fund classifications. Now this is about the fund. Yeah, it's a convertible arbitrage. They exploit mispricing or anomalies in the price of convertible securities such as convertible bonds, convertible preferred stock, or warrants. Now, let's take the example of a convertible bond, right? A convertible bond is something like this. What I explained just now, the case of a marker. So instead of clip and a pen, convertible option bond might be bond plus, write it the other way, sorry, might be call option plus a bond gives you a convertible bond. Now, a convertible bond is a bond which can be converted into shares at some point in time. Right? So, the conversion ratio might be, let's say, for example, right? I'm just taking an example. For want of an example, I'll use a company. Let's say this has been issued by John Keels, right? So, John Keels, currently the share price, let's say, is 145, and they have issued a 5-year convertible bond, right? 5-year convertible bond, and the convertible or the conversion ratio is at maturity. In 5 years at maturity, if the share price of John Keels is 200 or more, then the bondholders are given the option to convert it into shares of John Keels. Right? So 200 rupees, right? Meaning, sorry, I'll come again. Right? Forget that. So it's a 5-year convertible bond that John Keels has issued. Right? Current market price is 145. What they will say is, in 5 years, you can convert 2 of your bonds into 1 share. 2 bonds into 1 share. Right? So 2 bonds is 200 rupees, isn't it? 2 bonds, 200 rupees. Now, when do you think investors will prefer to convert it into shares? If the share price in 5 years is 250, or if it's 150. The option is to convert these convertible bonds into shares in 5 years. So 2 bonds you can convert into 1 share. You will prefer to convert if the share price is 150 or if it's 150. What do you think? What do you all think? Yeah. Okay. Now, let's say John Hughes has issued a bond, right? 5-year bond. It's a debenture. I'll just call it a bond. 5-year bond. The bond has a value of 100 and it matures in 5 years. The current share price of John Hughes, let's say, is 145. That is the share price. So John Hughes might say this is a convertible bond, and the convertible feature or the conversion ratio is to convert 2 such bonds into 1 share. Right? 2 bonds into 1 share in 5 years. So when do you think investors will prefer to convert this? If the price of the bond is 2 such bonds means each bond is 100, 2 bonds 200, right? Investors will prefer to convert it if the share price in 5 years is 250 or if it's 150. That is a question. What are your thoughts?
$250.
Very good. Yeah, 250. Why? Because you will be converting 2 bonds into 1 share. 2 bonds is 200 rupees, right? Now, you have 2 options. Now, you can either redeem it, in which case for 2 bonds you get 200 rupees, or you can convert it into a share. Now, if you convert it into a share at that point, instead of getting 200 rupees, you'll get 1 share. And if 1 share is worth 250 rupees, you will prefer to get the share, no? Because if you convert the bond, you get only 200. But if you get 1 share, you will get 250 rupees, right? So if the price goes up, then it will get converted into shares. That's called a convertible bond. Okay, now remember the clip and the pen example. This is how a convertible bond is structured. You have call option and a bond, ending up with a convertible bond. What should be your strategy? Identical to the market situation. Your strategy is the same. Which side should you buy? You should buy the convertible bond or the call option and bond. How would you arbitrage? Yeah, you will need to buy the cheaper side, right? The cheaper side is a convertible bond. So you buy convertible bonds and sell the call option separately and sell the bond separately. Okay, so this is the convertible bond. This is the convertible bond. You buy the convertible bond, then you remove the call option, sell it. You remove the bond and sell it. You make profits. Understood? So that's called convertible arbitrage. You are using arbitrage. The other one is distressed securities. Distressed securities are securities which are about to go bankrupt, right? So hedge funds might buy shares of companies which are about to collapse. Why? Remember Barings Bank, right? Barings Bank was sold for a price of £1, and 10 years later it was sold for $225 million. Yeah. Now, if you're a hedge fund, you would have bought Barings Bank spending only £1. But 10 years later, you'll make $225 million, right? So that's what hedge funds do. They will buy shares at dirt cheap prices, hoping to turn it around and sell it at a huge profit later on. Distressed securities, fundamentally different investments that conventional debt and equity investments. Distressed securities are generally illiquid, making it difficult or impossible to short the security, right? Because there are no buyers. The resulting securities may be undervalued and offer superior returns. Like Barings Bank, for £1, 10 years later, you sell it for a massive amount. Kill, right? It's a huge killing. These funds are generally long, only long. You can only go long, you can't go short on these funds. Hedge fund classifications, you might invest in emerging market securities. Now, emerging markets are the lesser developed markets, which, because they are lesser developed, their returns can be far superior than other markets. So Sri Lanka is also part of emerging markets. So you have a emerging market index. Generally only permit long positions, and often there are no derivatives to hedge these investments. Equity market neutral, they combine long and short positions in undervalued and overvalued securities. Okay, equity market neutral combines long and short positions in undervalued and overvalued securities, so that you eliminate systematic risk. Right? So systematic risk is the risk that is within a system. It can be eliminated through diversifying. So that's why you're buying long and short positions of under and overvalued securities, while capitalizing on mispricing. Yeah. So you eliminate systematic risk and capitalize on mispricing. Hedged equity strategies. You take long and short positions in under and overvalued securities to exploit mispricing. Unlike market neutral funds, they do not seek to remove systematic risk. So they're called hedged equity strategies. You take long and short positions in under and overvalued securities, right, to exploit mispricing. So it's something like arbitrage. Unlike neutral funds, they do not seek to remove systematic risk. They might be net long, short, or hedged based on the manager's view of markets. Right. Fixed income arbitrage. They involve taking long and short positions in fixed income instruments based upon expected changes in the yield curve or the credit spread. So their focus is on fixed income. They don't get into equity. Right. Again, arbitrage based on mispricing. Then global macro strategies take positions in major financial and non-financial markets through various means like derivatives and currencies. The distinguishing feature is that they tend to focus on an entire group or area of an investment instead of individual securities or classes of securities. Right. Global macro. You look at the global picture and take various positions. Right. You are investing in a global investment framework. Merger arbitrage or deal arbitrage. Now here, what you do is you expect two people to get married, two companies to get married, right? So you buy shares of both companies or one company and you expect it to merge with another one, right? So the combined entity might be worth more than the two elements put together. So for example, if A and B are going to merge, right? Let's say two banks are going to merge. Then you buy shares of A and you buy shares of B, right? Once they merge, you feel that the combined entity will be worth more than what you spent earlier, right? This can also happen in a spin-off. What you do is you buy shares of a bank and you or any company and you expect them to split. That would be a spin-off. So the amount you spend to buy the total entity might be less than what you get when they separate. Right? It's like a divorce. You might expect value addition through a divorce or value addition through a marriage. Merger arbitrage or deal arbitrage focuses on returns from mergers, spin-offs, takeovers, and so on. For example, if company X announces it will acquire company Y, the manager might buy shares in Y and short X, right? So you can have various strategies. You can go long one share, short the other share, but your expectation is that by going long, the value will increase, or by going short, the value will drop. Then fund of fund. Now, if you're a hedge fund, you go and invest in other types of hedge funds, right? For various reasons. Maybe you don't have market access, which the other fund has. So you simply go and invest in other hedge funds, right? It's called fund of funds. Describes a hedge fund that invests in many hedge funds. The idea is to get diversification among hedge fund managers or styles. There is a fee paid to the manager of the fund of funds, as well as to the managers of funds in the funds of funds. So lots of fees involved, right? Because lots of funds, not just one fund, but many, many funds. So much of fees, but overall the returns also can be very high, because you're going to get the best of all the worlds. Pension funds. Okay, so those, what we just discussed, were hedge funds. Right, remember them, some of them at least, remember 5 of them. Very easy to remember the arbitrage ones: fixed income arbitrage, merge arbitrage. Right, then you can look at global macro, fund of funds. Okay, so remember all of these, at least 5. Might get tested at the exam. You might be asked to write brief descriptions of each of those. So it's good to remember at least 5. Now, a pension fund and a provident fund. What is the difference between pension and provident? What is a pension fund? What is a provident fund? What is the difference between a pension fund and a provident fund? Yeah. The difference between a pension fund and a provident fund? In Sri Lanka, what do we have mainly? In the corporate sector, we have, Malaysia says, a provident fund is a retirement fund run by the government. A pension fund is a retirement plan run by the employer. Pension funds operate like annuities. Yeah, okay, you're somewhat there. Well, Sri Lanka, the biggest fund is our pension fund, or the EPF. Sorry, that's the EPF is the Employee Provident Fund, right? What am I saying? EPF is the biggest fund in the country, so it's somewhat of a pension fund. But the difference between a pension and a provident fund is pension gives the beneficiary a certain amount until he dies, but a provident fund will give you a lump sum at the time of retirement. Right now, in Sri Lanka, in the government sector, you usually see the pension scheme, but in the corporate sector, what they mostly have, more often have, are the provident fund, right? Except there are a few companies like certain banks which also have the pension scheme. Yeah. So that's the difference between pension and provident. Okay. A pension fund is a fund established by an employer to facilitate and organize the investment of employees' retirement funds contributed by the employer and the employees. Now, the employees' retirement fund is contributed by both parties, employer as well as employee. The pension fund is a common asset pool meant to generate stable growth over the long term and provide pensions for both employees when they reach the end of their working years and commence retirement. Right? Quite obvious. Pension funds are commonly run by some sort of financial intermediary for the company and its employees, although some larger corporations operate their pension funds in-house, right? Where you can either, in Sri Lanka, usually most companies use the government pension fund or the provident fund, the EPF, whereas in some cases, some companies have their own provident fund, right? So some of the older companies, the mature companies, have their own provident fund. Pension funds control relatively large amounts of capital and represent the largest institutional investors in many nations. Right? In Sri Lanka, it's easily the biggest fund in the country. Right? Easily the biggest. So two types of pension funds. One is called the defined contribution plan. A defined contribution plan. Now, in the defined contribution plan, the monthly contribution that the beneficiary as well as the employer makes is defined. It might be a fixed percentage of your earnings, right? So it might say the employee contributes 5% and the employee contributes 8% and the organization contributes 12%, right? So total of 20%. Sometimes it's 10% and 15%. So it can be fixed, but there is a minimum percentage. The organization has to contribute minimum 12 or 15% minimum, whereas I think it's 12. The employee should contribute minimum 8%. Right? Can be higher, but not less. So maybe 20 to 25% of the salary is contributed as a pension fund into the pension fund. So defined contribution pension fund is where a fixed percentage of your monthly salary, your salary drawn on a monthly basis, is contributed to the fund. The retirement plan emits a certain amount of or percentage of money set aside each year by a company for the benefit of employees. There are restrictions as to when and how you can withdraw these funds without penalties. Right? You can't withdraw your investment prematurely, not before your retirement age. Exceptionally, they might allow, but there can be penalties. You might not get the full benefits. There is no way to know how much the plan will ultimately give an employee upon retiring. Now, when you retire, you don't know how much you will end up with. The amount contributed is fixed, but the benefit is not. Then you also have defined benefit plans. Okay, that's a plan which tells you when you retire, this is how much you will get. Defined benefit. So the benefit is defined, not the contribution, but the benefit is defined. An employer-sponsored retirement plan where employee benefits are sorted out based on a formula using factors such as salary history and duration of employment. Right, so it's based on a formula. If you know the formula, then you can roughly work out how much you will get when you retire. Investment risk and portfolio management are entirely under the control of the company. So the company invests on behalf of employees, and if there's any shortfall of the defined benefit, then the company has to plow it out of their earnings. Right? It's so the company in that case is taking the risk of the investment. Now, in defined contribution, the employee does not know how much he will get when he retires. Right? So the risk of the investment in that case is with the employee, but defined benefit is the other way around. The employee knows when he retires how much he will get. Right? So if there's a shortfall, it has to be bridged by the employer. In that case, the employer takes the risk of the investment. If there is any shortfall, it has to be bridged by the employer. The investment risk and portfolio management are entirely under the control of the company. There are also restrictions on when and how you can withdraw these funds without penalties. Again, you can't withdraw money at will. Right? There will be penalties. Employers will need to dip into company earnings in the event that the returns from investments devoted to funding the employee retirement results in a funding shortfall. Yeah, so if there is a shortfall in the benefit, any shortfall, the employer has to bridge the gap using his own earnings. Right? You can't penalize the beneficiary or the member. Sovereign wealth fund. Right? Sovereign wealth fund is a fund that is formed for the benefit of your unborn citizens or the future. Right. Now, this happens if a country has a budgetary surplus. Right. So that means if a country's budget, right, the difference between tax revenues as well as expenditure. Now, it's not only tax revenues, but a government's budget deficit. That means all revenues of the government minus expenses, right? So revenues can come in the form of taxes, rates, maybe fines, all revenues minus expenses, maybe on welfare activities, social welfare and all that, salaries and all that. Right? So if there is a surplus between the two, right? So if the revenue is more than the cost, the government will be left with a budget surplus. Okay, so if it has a budget surplus, and there are two things the government can do. One is to spend the surplus. Okay, so let's say there is revenues of 200, expenses of 150, and there is a budget surplus of 50. Two things the government can do. One is they can start spending on maybe infrastructure development or something like that, right? So if a government starts spending, there will be more money circulating in the economy, and when there's more money circulating in the economy, it can lead to inflation. So government spending can lead to inflation. That is one thing they can do. The other thing is to form a sovereign wealth fund. That means rather than spending, they spend for the essential things, and whatever still remains, they will invest for the future. And so they have a broader vision, and they are investing on behalf of the future. If there is a rainy day, it can be used by the citizens in the future, and this is futuristic. So there are countries now. The biggest sovereign wealth fund is in Norway. Norway has the biggest Norges fund. It's either Norway or Japan. I think it's Norway. A sovereign wealth fund is a state-owned pool of money that is invested in various financial assets. Right? So if a country has a budget deficit, it's totally difficult, very difficult to have it. It's in fact impossible to have a sovereign wealth fund if your country has a deficit. But countries which have a budget surplus will inevitably have a sovereign wealth fund. A sovereign wealth fund is a state-owned pool of money that is invested in various financial assets. The money typically comes from a nation's budgetary surplus. If you have a deficit, there is no chance of having a sovereign wealth fund. When a nation has excess money, it uses a sovereign wealth fund as a way to funnel it into investments, rather than simply keeping it in the central bank or channeling it back to the economy, which is inflationary. If the government's balance sheet starts increasing, it can be inflation. It is like money printing. The primary function of a sovereign wealth fund are to stabilize the country's economy through diversification. Okay, so it's diversifying, investing in the right areas. Now, the Norway fund has invested even in countries like Sri Lanka, emerging market assets. Stabilize the economy through diversification and to generate wealth for future generations, right? Sovereign wealth fund. Usually it's managed by the wealthy nations. Okay, so that's it for today. Any questions? Do you all have any questions? Sorry, there is a question. Sanjeev says for pension funds, also are they getting paid lump sum similar to provident funds with monthly payments when they retire? The pension funds don't pay a monthly lump sum. Provident funds will give lump sum. Okay. Any further questions? No further questions. Okay, so we can wind up for today. We again meet, remember, on Friday, and then again on Sunday. So we have a class on Friday, 3:30, 5:30, and then we meet again on Sunday. Okay, guys. So thank you very much. Stay safe. I will see you on Friday.